offers investment
towards neutrality. Maybe it's 75 beeps
Sure.
now, maybe it's 50. What do I know? And then every step from there becomes excruciatingly difficult. And we are there right now.
Jamie Dimon at JP Morgan spoke to CNBC in the last couple of weeks, and he talked about the next 100 basis points of tightening from the Fed being the most painful 100 basis points. I'd extend things just a little bit, Lisa. I think politically, it's going to be the most painful 100 basis points, not just for the Fed, but maybe for the ECB as well.
I would agree. I also think, though, that at this point, if they don't continue to hike, what is the response from the bond vigilantes on the long end? Do you start to see borrowing costs surge in a way that becomes political untenable regardless of what they do?
The ECB decision coming up a little bit later. Earnings from Apple and Amazon. What a Thursday. Some economic data coming up at 8:30 Eastern Time. We'll break that down with Mike McKee. Coming up shortly, Sharon Bell at Goldman Sachs in the next hour. Looking forward to that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank is set to lift main interest rate hikes to the highest level in more than a decade. It's trying to lower record high inflation. Almost all economists surveyed by Bloomberg predict a second straight 75 basis point hike today. President Xi Jinping in China is willing to work with the U.S. to find ways to get along. The comments came before a possible meeting with President Biden next month at a Group of 20 summit. It signals an effort on Xi's part to maintain ties despite disputes over everything from Taiwan to chips to the invasion in Ukraine. Russia has carried out military exercises simulating a retaliatory nuclear strike. Vladimir Putin oversaw the drills. Secretary of State Antony Blinken told Bloomberg that the U.S. has warned Russia that any use of nuclear weapons in the war against Ukraine would have grave consequences. And Credit Suisse is planning a sweeping overhaul. It includes $4.1 billion in capital raise, a carve-out of its investment bank, and thousands of job cuts. It's the most urgent attempt yet to repair Credit Suisse after huge losses and management chaos. In breaking up the investment bank, the firm will create a separate advisory and capital markets business that will revive the First Boston branding. And the world's richest man told Twitter employees he doesn't plan to cut 75% of staff. Bloomberg's learned that Elon Musk denied the numbers in an address to workers at the company's San Francisco office. Still, the billionaire is expected to cut staff when he takes over the company, causing anxiety among workers. The $44 billion deal set to close Friday. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish, and complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
The markets count down in Europe from the financial centers of the world.
Amundi offers investments which encourage companies to change for the better. And you, in what world do you want to invest your money and your future? Amundi, confidence must be earned.
Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
A big beat.
Stock is up more than 8%, coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We want to go through the transformation of the next 3 years with a very, very strong capital base and leave the transformation also with a very strong capital base. It will become profitable definitely from 2024 onwards.
What a tough morning for everyone working at Credit Suisse this morning. Good morning to you. That was the Credit Suisse CEO. The stock is down in Swiss trading by almost 12%. From New York, let's get to the price action. What a day we've got coming up for you. Outside of Credit Suisse, we've got earnings from Apple and Amazon after the close. We've also got an ECB rate decision. Equities look like this on the S&P. We're positive on the S&P by almost 0.1%. Yields are higher by 6 basis points on a 10-year. Just north of 4%. The euro's weaker going into that ECB call a little bit later, Tom. Euro dollar just above parity still, a one handle on the euro.
For Global Wall Street now, an informed conversation on the disaster known as Credit Suisse. It is trading on a book value basis. This is off the BQ screen on Bloomberg. It is apples and oranges, 1.4 something for JP Morgan, a little bit better for Morgan Stanley, really showing the successful decade of James Gorman, and Credit Suisse, 0.24. That's all you need to know. That's what Marcus Ashworth knows of Bloomberg opinions steeped in EU banking. Marcus, you and I go to dilution, except you and I know the calculation of equity dilution is complex and is usually something failed on a CFA exam. How bad will the equity dilution be for shareholders of Credit Suisse?
Well, I think they're learning a lesson of their compatriot bank, Swiss Bank, which merged into Union Bank of Switzerland to create the UBS model. 10 years ago, UBS decided to cut through, muscle, bone, everything to get to a level whereby they could be appreciated on the stock market. It looked like, wanton destruction as we are looking at Credit Suisse now. We're seeing, all sorts of things going on which, look unpalatable. And silly in some senses. Some of the most profitable parts of the bank are going to be hived off. But, if it results in, as you said, that tangible book value of 0.25 or whatever it is, doubling and then going again up towards just tangible book value at some point in the next few years, that will be deemed a success. And that's all the management care about.
Marcus, what is the timeline to find the formal dilution of these set of transactions? To me, it's a 3-year timeline, even though they're talking it up in a cup of coffee. Is it 3 years, or is it even longer until you let the dust settle on dilution?
Oh, I think there's got to be substantive, real results well before that. They may take 1 or 2 years beyond that, but you've got to have the direction of travel clearly laid out. They need partners clearly on the investment bank, CSFB. They need partners into the structured part of the product group or sale thereof. They need real results and something absolutely clearly happening. Credit Suisse is about a private bank, a wealth management, and asset management. The rest of it, is important, but it's not vital, and that's clearly what they're showing here. The amount of capital they're putting in investment banking, they're hiving off the successful glory bits of stateside stuff. That's where the money still is. The European side, not so much. That's going to get withered on the bone.
Marcus, Credit Suisse is its own animal. It has its own pain. It has its own story, but it is within the microcosm of the European banking system, which faces a sort of regime change today, potentially, if the ECB doubles the deposit rate, if they double the benchmark rate. They've been used to the highest levels in more than a decade. How much does that change the scenario in a positive way for banks that have been looking for higher yields, higher rates for a very long time?
Difficult one. Not very much. I mean, especially if it causes a recession, which is quite likely, I think, in my mind, that we're already probably in a recession in Europe and it's going to get worse. So hiking interest rates and doing some other things as well. I think it's the other bit, the complex monetary plumbing bit, which is these excess reserves. A lot of banks borrowed up to 2 trillion euros at as low as -1%. They've got that free money locked in. And as you say, if deposit rates go up to 1.5, they can sit and park their money back at the ECB at 1.5%. What a lovely round trip. That's too generous. And clearly the ECB will want to do something about that. If they overdo it, they're going to cause a liquidity withdrawal or potential financial conditions nightmare, like we saw in the UK recently, and perhaps a collateral squeeze as well. They may lose control of their money market rates. They could get this very wrong. They could get sued. There's all sorts of things that could go wrong with positive rates for the ECB. It's quite a new world. They are so used to negative rates, they haven't quite worked out what it's like above ground.
Which raises a question about what they're going to do in December, and that's what people are really looking for today at the ECB rate decision, in terms of whether they ratchet back some of their plans to raise rates. Do you think that that's what the market is basically asking for, and that financial stability will be an increasingly pressing concern if they signal an ongoing aggressiveness?
Yeah, I think the answer to this all lies, as ever, not with the ECB, but in the Federal Reserve. What the Fed do on November 2nd is key to everything. If the Fed do slightly pivot or say that the next hike won't be something like another 75, it gives the ECB the freedom they so need and want to perhaps only do 50 in December, and probably will stop it either there or very soon thereafter. They will talk a bigger book. They have to keep that euro back above parity. Just gone back above, first time for quite a while. They'll want to keep it above parity, and therefore they'll want to keep talking, but they really want the Fed to ease off.
You'd have to imagine, Marcus, by the time we get to December, there's a forecast that spouts out recession. Isn't that? Is that avoidable?
No, no way. I think absolutely. UK, Europe, they're already in recession in all but name, and it can only get worse the more they hike interest rates, let alone talk about withdrawing stimulus too hard. They get the quantitative tightening wrong and all this reduction of excess reserves. A world of pain is coming.
Marcus Ashworth, thank you, sir. Out of London. That's the problematic view of things, Tom, when it comes to the ECB. The fact that their base case doesn't include right now a recession in the Eurozone. Next forecast, I believe, come in December. And when they sit down in December, Tom, you'd have to imagine there's some form of downturn, some real downturn in that outlook. And how do you hike again 50, 70 basis points if that's the case?
I was remiss, John. I didn't look at this when I came in this morning, and it is the Bloomberg Financial Conditions Index, which I've mentioned a number of times. England and America are very close, and they've improved here over the last number of days. ECB is stunningly different. This is a different press conference than what we're going to see from Chairman Powell.
There is one really big piece of good news, though, in Europe when it comes to the gas price story.
Yeah.
Lisa, is so much better than it could have been at this time of year, primarily because it's been warmer than most people thought it would be.
And this is what I'm struggling to understand. At what point Is this a positive development that has really fully been bled through into markets versus what everyone seems to be saying, just wait until actually the winter comes because it hasn't gotten cold yet? And I was reading a story about daylight savings time being actually a nightmare for the European region because people turn on their lights earlier and that uses up more energy. There are all sorts of things that people are looking for. I know you look skeptical, but these are some of the things that are
I've been
like,
looking forward to getting rid of that for a long, long time, haven't you?
I wonder how much pressure there is. Yeah, I mean, I wonder how much pressure there is this time from an energy perspective because it creates a little bit more difficulty.
We fall back.
You fall back.
We fall back.
Oh, of course.
We spring
and
forward.
You spring forward.
Thank you.
That's right.
It's my value add for the day.
We'll all remember that, Tom. Thank
That's
you.
my value add.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
3 hours away from the opening bell. Here's the price action for you. Starting with the equity market on the S&P 500. Futures just about positive on the S&P. Let's call it unchanged. On the Nasdaq right now, we're negative 0.5% on the Nasdaq 100. Meta is down and down hard, but like yesterday, it's not bleeding in a major way. We're down about 19% on Meta. Yesterday, we were down hard on Alphabet, call it Google, Tom. Down hard on the likes of Microsoft. We were off by almost 8%. But as I say, if you strip it out, if you equal weight that S&P, we were positive yesterday, Tom, and I think that might be a surprise for some people out there.
You followed this closer than me, but there's got to be a separation here. This is about Mr. Zuckerberg, right?
Oh, without a doubt.
It's like the Mustang with the sink walking into Twitter. Google's about Google. Right.
Sheryl Sandberg's left. Facebook is kind of a mess right now. The outlook, they're investing in a very uncertain future, Bramo.
Yeah, she's got the Bramo
the metaverse, the rebrand. Take it.
Well, how much is this really the push-pull of the negativity? Yes, of Meta, Facebook has its own challenges, but we're seeing the same thing across the big tech names that have reported. How much is this the specific situation of FX headwinds and an economic downturn on one side, and then the step down, the potential for the Fed to not hike rates quite as much as people had expected on the other, providing optimism to the other sectors? It's the push-pull.
I thought Neil Dutter of Renaissance Macro was just awesome yesterday. Sat in that chair and he just said, step down is implicit in the dot plot from the Federal Reserve. This is not news. Why did you need a journalist at the Wall Street Journal to write this up for you and summarize what people have already said and what is in the guidance?
I could not agree with him more, and you've raised the issue about how strange it is that we seem to be agreeing.
John mentioned this before air. John and I usually don't talk before air, but, we spent 30 seconds today catching up. And, John, you mentioned it. Everything in the S&P looks good versus the tech challenges that are out there. Caterpillar just out. I'm sorry. Caterpillar's not a tech company, and they're up nicely. They go from a 197 up near a 200. A little bit of a lift there on a CAT after earnings.
EPS 395, the estimate 318.
Pretty good.
That's a big beat, Tom.
Maybe that's what we're going to see. Let's do this. Let's dive to the ECB now. I'm going to ask a couple questions. You can get out of the way of John and his real expertise on this. Christian Schulz is with Citigroup, the Deputy Chief European Economist. Christian, I mentioned earlier the fancy math of the Bloomberg Financial Conditions Index for Europe. It is extremely challenging. How much will Christine Lagarde's press conference be treated today, touched today, by the grim financial conditions of Europe?
Well, it will play a role, I think. I don't think it will have much of an impact on the rate path, on what Christine Lagarde's going to decide and her team are going to decide today, the 75 basis point rate hike, or what's going to follow on later. But it will play a role in how they think about reducing the balance sheet, because that is clearly the next thing that's going to come up. That's going to be in focus, I think, also in the press conference today. And that's where they really need to be careful to not make things even worse on the financial conditions side. Obviously the Italian question, but there's many other issues in the plumbing of the financial system that need to be dealt with.
Sounds like a movie. The Italian question is, well, John, jump in here on the balance sheet.
Well, I think beyond the balance sheet, Tom, the Italian question right now, if you want to deal with that, Christian, it's the Italians asking the questions, not the Europeans asking the questions of the Italians. You've got the new Prime Minister essentially, and not subtly, going after the ECB about hiking into a downturn and the pain it could cause, backing away from bond buying. Christian, how do you think this ECB will grapple with a different kind of politicization?
Well, they've created a tool, the TPI, the Transmission Protection Instrument, in order to deal with spread widening where it's not fundamentally warranted, so where it's not caused by a policy error that governments themselves need to fix. That is a bit of a warning to this Italian government, not to play by the rules, but it's also a guarantee that if they do, the ECB will be on their side. Will it be enough if trouble really starts hitting the proverbial? We are a bit skeptical. It's big on paper, this tool, but the mechanism of actually activating it and everybody agreeing on it, we think is very difficult. So it's clearly a very, very difficult situation, but it starts with Italy itself. They have to play by the rules.
With that in mind, is it too early to discuss QT at this meeting?
QT will inevitably have to be discussed and will have to be decided and will have to happen the minute the ECB moves beyond neutral on the policy rate, because you cannot have the policy rate being restrictive and or stepping on the brakes and at the same time having a balance sheet setting which is still supportive to the economy. So at that point, the ECB is going to have to start QT. We don't think that the ECB will reach restrictive territory before the start of 2023. So there's still a bit of time, and with all the complications, they better take their time in thinking about it. But come, say, April next year, they will be reducing their balance sheet. And come December, they'll probably decide about this. And today, they may even hint when they will do this.
They will plan to start that in April. They will plan to continue following the plan. But right now, according to their plan, there will not be a recession in Europe, even though every major Wall Street bank and beyond seems to think that there will be. Do you expect them to revise that expectation today?
Well, today is obviously not a meeting with new forecasts. They clearly signal that things have played out worse than they perhaps expected in their last set of forecasts in September, which will signal that a recession will probably be part of the base case in December. We've always said that they won't get very far in their rate hike cycle because of this. But at the same time, inflation is in double-digit territory. We'll see in the next few days where it's going next. It is broadening. Demand seems to be recovering too fast for supply to catch up. There is a case for the ECB to hike into a recession, of course. And I don't think they'll let a recession of, say, the garden variety stop them.
You know, Tom, I do wonder how much some of the American tourists end up being part of the demand story, given the fact that everyone and their mother seems to be going over to Italy.
Just as a quick aside here, but I think Paris is traditionally 17%, 20% of French GDP, and then all of a sudden it was 25%, then it's 27%. With the new tourist boom, I wonder if that tips over 30% of French GDP.
And if you look at all the airlines, September and October is the new summer just because people can work remotely. I wonder, Christian, from that perspective, some of the gains that you've seen in the recovery, does this make the ECB's job harder? That if they are not aggressive enough, you end up with inflation that is more persistent, and you end up with market vigilantes coming out and penalizing the ECB for their actions?
Indeed, there is a strong consensus, at least in parts of the, among observers, that the ECB is behind the curve, that it failed to realize that, all the stimulus that the government's injected in the economy during the pandemic was going to have some impact on, a strong impact on demand when supply couldn't recover quickly enough, and that supports inflation, and that raising interest rates earlier maybe would have made the whole process a little smoother. I think, of course, we all agree that really most of the inflation has nothing to do with the European economy. It comes from external. It comes from Mr. Putin's war in Ukraine and everything that happens around energy, which the ECB cannot do anything about. But clearly there is a rise in inflation expectations, which we observe.